What's going on, y'all? My name's Carl Joseph Black,
I'm Jonathan Jackson.
and this is Due Dilly. Uh, Welcome. We're finally back from a 3-year hiatus. For those who are new to the game, John, let's tell them what Due Dilly is.
Due Dilly is a show about deals, paperwork, and how they connect across media, finance, and the wider creator economy. I'm an entrepreneur and operator. Carl is a lawyer that works across ventures and debt. And so we take our expertise and we break down what's happening, why it matters, and how you can build the things you want to build right now and tomorrow.
And today, we're talking about the creator economy. A lot of folks have been talking about the creator economy for a while. There's been tons of news, tons of new people entering the space. And, as a result, a certain group of people got really interested in the last few years in what the creator economy is and what it has to offer. And that group of people is Wall Street. Wall Street is dumping money into the creator economy. That's the thing with Wall Street. Wall Street has always been obsessed with one thing, and that's turning culture into capital. They did it with radio and TV. They did it with Hollywood studios, movies, all types of films. The entire industry, they financialized that. They financialized music. And for them, they're seeing this entire cultural shift coming online. And they're saying, okay, it's time for us to figure out a way to financialize that. And the question is, why is that? But before we get into that, what is the creator economy? What do you think, John? What is the creator economy?
It's a lot of things, but I found a definition by a writer and financial analyst named Kyla Scanlon. She describes the creator economy as a system that's decentralized, open source, and allows individuals to own the creative output. So we should break down what all three of those things mean. Decentralized, it means that you can be an independent economic actor, so you can be free moving in the system. Open source means it's available to the widest amount of people possible through the distribution of the internet. Because on the internet, there are no borders. Own your creative output means that the creator economy is an economic definition being used as a cultural one. So that means that while we are all creative as people, I think we all have the ability to be creative. Being a creator is what happens when you are able to monetize some of that impact for yourself. And so sometimes the definition of being a creator is used as a defining factor of a person, where being a creative is actually something that doesn't require you to be qualified as a creator to do it. So that's important because I think as we talk about this, those words get used interchangeably, but they're actually not. One is an economic definition and one is a way of life. And I think if you get those two things mixed up, it can kind of get hazy in terms of what you want to do and what you care about.
Yeah, and that's the thing. As folks continue to pour money into this industry, you're actually going to start seeing the economic actors and the folks who are identifying themselves as creators. Some of them are going to meld together, but some of them are actually going to be distinct. And that's going to be interesting moving forward when we think about who it is that ends up being funded. Um, when we think about folks who are landing larger brand deals or how different creators are actually achieving economies of scale. These are some of the things that like investors are going to use to actually delineate folks. So when you hear somebody on CNBC say, hey, we're investing in the creator economy.
We've made a big bet on the creator economy and kind of diversifying our entire company as we're seeing so many eyeballs migrate to social media, migrate into YouTube. And so we, as premium content makers, want to be connected to that space. Wherever our eyeballs go, we want to be.
Is that a comment on what the legacy guys are doing?
Well, they're also starting to activate it a little bit. You saw the Mr. Beast TV show for Amazon being announced. We have the Mormon Wives, who we represent through Select, one of our digital agencies, which is a huge show for Hulu. And I think there's obviously the ability to migrate that talent. but going where the audience is to also work with that talent to kind of up their game on who they're selling to, what advertisers they're talking to, as well as what kind of brands they themselves can build now that they have a direct-to-consumer relationship.
They're talking about a very specific type of creator. And one of the things that we're going to be focusing on in this season is ensuring that at the very least you can choose to qualify for what that type of creator is. But at least understanding like what are the metrics, what are the structures that they're looking into. But I think the first thing we should probably start with is what the signal was. Um, and to me, the major signal that kind of told folks, hey, Wall Street money's coming is the Goldman Sachs report from earlier this year. I believe it's from March 2025 that basically said, hey, the creator economy is going to be worth $500 billion by 2027. I don't know, John. What are your thoughts?
Yeah, so I think there's two things. One, Goldman made that announcement of sort of the total market size in 2023, and that sort of 480, 500 billion number is thrown around everywhere. VCs use it, creators use it, the street uses it. And I think that's important because when you have something that's new and is developing, it's hard to anchor it because people haven't seen it before. We haven't seen it this way. This report from March 2025 um, comes out of their America's Technology Group. And it's really important because what it does is it takes that $480 billion number that they anchored in 2023 and expands on the infrastructure. So one of the things that they cover in the report is this idea that there is an actual expansion of what the creator economy is, not simply for the people that are making things, but the infrastructure that supports the making of things. So in Goldman Sachs's construct, they talk about six distinct businesses to them that represent what and how the creator economy gets built. So they talk about Meta, right? So when we talk about Meta, we're talking about WhatsApp, we're talking about Facebook, we're talking about Instagram. They talk about Alphabet, right? The largest store of the world's information index that you can search. We're talking about YouTube, right? And we'll get into that later, but YouTube has essentially replaced the traditional notions of how TV functions in our everyday life. They're talking about Spotify, right? Musicians are also creators. Spotify reimagined how you could do streaming along with some other players in the game. They're also talking about Webtoon. Webtoon is a business that focuses on anime, manga, which are huge, huge communities of both cartoon fans, anime fans, and people that are interested in sort of that entire ecosystem and structure. And so when you think about those businesses and what those businesses mean, Goldman's entire purpose is to think about how creators are building increasingly large businesses and how these tools, these enablement tools, are helping creators establish deeper relationships with users, with other entities, and then more broadly, how they're able to monetize their influence and create and fund sustainable businesses that are then interesting for larger forms of capital to take part.
Yeah. Um, what what makes this interesting is that Goldman, at least from my interpretation of the report, Goldman's whole thing, at least their stance is, hey, uh, the creator infrastructure is done. And it's time for us to actually start looking beneath the hood and seeing what the actors are doing on here. Right. Which is actually like interesting in two ways. One, because it tells me, okay, great. Like, well, we kind of know who are the people who are basically going to manage the rails. I'm looking at it from the perspective of a financial system. And when you're thinking about it from there, it's as if, hey, we just made Swift. So Swift is done. So anybody who makes a bank now can just jump on Swift. So if you're a creator, you're probably going to be using these platforms, right? And now it's who are going to be the folks that are going to build the best creator type infrastructure, the best creator businesses, right? So if you're looking at it from the perspective that I shared earlier, so now that the rails exist, who's going to build the best bank that serves XYZ, ABC, who serves this part of the US versus that part of the US? And who are we going to choose to invest in from here moving forward? Now, the other interesting thing is what you stated earlier in terms of the group that actually published it, Goldman's technology group, because Goldman is super well known for their M&A work in telecom, media, and technology. They are basically the tier one financial institution for those mega type deals. So if you're hearing of a huge media company either getting bought or sold, usually is Goldman Sachs. That's the investment banker structuring that deal, putting that deal together. So it coming directly from the equity research department of the TNT division is actually really interesting because basically they're saying, yo, we're watching, right? But we're gonna give y'all the report. Y'all are gonna definitely have access to that for download because we never talk about anything without sourcing it directly. But what I also want to do is kind of give people the why, right? Yeah. So the why is some of what John mentioned a bit earlier in terms of how the entire structure of consuming television content or content in general has completely shifted. It's crazy because what used to be, and when I say used to be, I mean what, last 10, 15 years?
Yeah, 20.
Probably 20, yeah. It was, hey, somebody's a creator, they create something on film, they create some sort of work that they want to see viewed by everyone else, and they would have to go through what they call traditional intermediaries. And the traditional intermediaries would be your Netflixes, your Apple TVs, your cable TVs, your Turners. And if you're a person that makes video games, that used to have to be like Activision or Rockstar. Um, but that used to be the exact road to get to your consumer. But that's completely changed now because now what has happened is that has turned into a fully decentralized group of tech companies. And now that's your YouTubes, your Spotify's, your SoundClouds, your Substacks. Folks are using blockchain now to create games and publish those directly. Um, Apple still is a little bit involved, but with those folks, what they're doing is they're becoming self game publishers and then publishing them through Apple. But everybody's going direct to consumer instead of actually working with these intermediaries. And what they're doing is they're just leveraging those platforms to give access for the consumer instead of actually going through the traditional intermediaries that mentioned before and basically getting an approval to talk to those folks. I want to know what your thoughts on that, John.
Yeah, I'm interested in the scope between how those things change. So in the historical context, you would go through that process of ideation, production, marketing, distribution, monetization, and the creative as like a function of that would be your writer, your musician, director of photography, animator, VFX artist, producer, makeup artist. So that would sort of be in the creative bucket. And then the traditional intermediaries would probably hire those people to facilitate the work of sort of getting that to the market. And then you have the consumption for the consumer. The massive change that I think has shifted things is that all of those 5 steps, including monetization, so ideation to monetization can now happen in the hands of the creator. So I can start my idea and use AI to help work it out. I can then go into production. Maybe I do a mood board using Midjourney and Gemini. I can think about what my marketing assets are, and then I can test them via Facebook ads because I already made the marketing copy. I can then plan the distribution through a platform like a YouTube or a Spotify video. Then I can think about monetization if I have a private community through a Patreon or through a paid subscription. And all of that happens with me. So what I have to decide is if I want to use an enabling platform, which platform I want to use, and how much of a subscription price I want to pay before I pass that savings or price increase off to the consumer. And what that means is that that value chain can be owned by me specifically. And if I own that, then I can actually change my value relative to what the market says, because I don't actually need as many people anymore. I don't need mass distribution. I need the right rails to get to the consumer I care about. And what's interesting to me is that that actually becomes really attractive for outside capital, because if you're able to attract a specific amount of people to take buying behaviors over a long period of time, that's a business. And if you can use the internet to scale that business, that's a business that might actually be sensitive or interested in outside capital. And outside capital always wants to be returned. And so if I want my capital returned, I need to look for environments or assets that are not necessarily responsive to the market. So I'm looking for outsized returns without having to deal in the traditional sort of S&P environment. And creator businesses actually can exist in a non-correlated fashion, giving me the new sort of interest in my portfolio of businesses that I otherwise wouldn't have access to, that I didn't even know people would buy. Like, I didn't even know this many people cared in about this many things, but the community aspect of how these businesses work mean that there's entire genres of business that are getting built overnight that nobody knew existed, right? Like podcasting, what we're doing here was not a thing people were thinking about. And people like us just showing up to a studio, recording, having a fire producer do a switch with us.
Big shout out to Wolf, bro.
Yeah, like that wasn't a thing that existed before it existed. And so I think the ability to do that has, as the price of technology lowers, the price of attention increases. And so now it's a question of how do I get as much attention towards the thing I'm doing and direct that attention for people to take action.
Yeah, so like for me, it looks like when you were, 10 years ago, you're an angel investor, and you probably put together like a holding company to invest in startups. You're like, yeah, I'm invested in Uber, I'm invested in Stripe, I'm invested in Pinterest, I'm invested in all of these new hot startups, right? Airbnb. And like as an angel investor, that's like your claim to fame. It's kind of like how you see Jason Kalinakis or Gary Vee say, I'm the third or the first or the second investor in Uber.
When I started as a journalist like yourself, I had interviewed him and stayed friends with him, and I had just watched him go through two companies and have rough patches at both of those, and I just thought, this is the most dogged entrepreneur I've ever met. He never gives up. And when he showed me what he was working on, I immediately said, hey, can I invest? And I was just starting my angel investing career now. I think that was maybe my third or fourth investment. And we just happened to run into each other at the Embarcadero, basically on the water in San Francisco at a party. He showed it to me, and I was like, well, it's obvious.
Now, what was it at that point that he showed to you?
It was literally one Lincoln Town car on a map moving around. And, you got to remember, the iPhone back then had just come out. It was a couple years old, and the App Store had just come out.
To me, the next like iteration of that is, hey, I'm the first investor in Mr. Beast. I'm the first investor in Cash Cobain. I'm the first investor in insert whatever cool creator is actually building like a strong scalable business. And that's what the future of portfolios kind of look like. And if they do look like that, that's the reason why Goldman is sounding the alarm, right? So I guess that leads us to kind of discuss a bit about where the money's coming from. Like who's out here saying, yo, um, I want to get into this.
So I think I want to segment this in two frames. There's the people who invest directly in creators, and then there are people who are investing in enablement tools or infrastructure that support the economy. So if we were going to talk about sort of a direct investment into a person, we need to look at Slow Ventures. Slow Ventures is a early stage venture fund that invests in technology businesses, and they've been very successful doing it. Recently, they rolled out a $60 million creator fund to invest specifically into creators and their businesses. They have a really specific thesis. It lands on 3 points. One, they believe creators are CEOs. So select creators are not just producers of content, but they're founders who are building scalable media companies with diverse revenue streams. Two, capital without control. So their deal structure, they invest for a share of future earnings rather than equity. So they do not take equity in the creators they invest in. They instead take shares of future profits. What that creates is the kind of alignment where they are actually not in control of how the creator operates their business. They can work as a partner in the long term of that creator. So they're trying to test out their thesis, because if they're right and they are early, they get rewarded with more deal flow. Three, they think beyond sponsorships. So they believe the most valuable creators will build sustainable businesses outside of brand deals and ad revenue, which includes products, services, and other scalable income streams that you would look for in a different business. They did their first $2 million investment in a guy named Jonathan Katz Moses. His story is wild. So this guy in 2015 has a life-altering event and assault. He almost dies. He decides that he's not going to waste his life anymore. And he goes, I'm going to do what I think I'm here to do. So he starts building woodworking tutorial videos out of a 120-foot shed he has in his backyard, right? No problem. Super interesting. Over time, he grows a massive following. I want to read from the investment memo we got from Slow Ventures. It says, since 2015, he's published 300 videos and accumulated 75 million views. He founded KM Tools, selling woodworking and accessories directly to his audience. He recently relocated operations to a 33,000 square foot facility to support increased output. His original content serves as a critical marketing engine, building trust, educating viewers, and generating product demand. He currently leads a team of 15 across content creation, tool production, fulfillment, and operations, having bootstrapped the company from inception. Cool. So it's just a couple things here, right? Like, this guy built a woodworking business after almost dying, has scaled it for the past 10 years, never took outside capital, is working out of a 30,000 square foot environment, has a team of 15, some of which are doing content. I just want to call that out. Like, he has people dedicated to the media and capturing what he does. The global woodworking tools market is projected to surpass $10 billion by 2030, driven by increased interest in DIY projects, maker culture, and home improvements. Jonathan's content flywheel has enabled him to profitably scale his business to mid-seven figures in annual revenue. Approximately 70% comes from proprietary and patented products. He increased in-house manufacturing and has full control over his fulfillment. So this means he owns his supply chain. So he makes a video. The tool in the video is something he made and has a patent for. He then tells you where to buy it, which is on his website. When you buy it, that means he fulfills it. He also has the patent, which means if you wanted to use it, you'd have to pay him to white label it. Then he sends it directly to your house, which means he can actually pass on the savings to you because he doesn't have to use another fulfillment.
Yo, that boy's a dog. He's a dog. Because this is what's crazy. Like, that man is basically running his own mini Home Depot.
Correct.
Like, and he started off making videos.
Yeah.
And like, that's the opportunity that creators have. And it's part of why we're doing what we're doing, because like, it's important for us to actually show people that it's not about just, oh, let me make a video or let me just post some stuff on social, then make some t-shirts, flip those. And then after I flip those t-shirts, I got a business, right? Like, you can actually think creatively about what it is that you want to build and build something with infrastructure like Jonathan did.
It's incredible. I'm going to do what's called a speed run. So I want to talk about a few other firms that instead of investing in creators directly, they invest in the tools directly, if that's cool. And then we're going to also talk about some private equity firms
Oh yeah,
invest in the other things. But for this section,
not to get juicy, bro.
I wanna bring out the munyan bonnet. It's important that people understand. I don't know. They said it's for the clips. It's for the clips.
You gotta do it.
All right, so Alley Corp, a New York-based venture fund and incubator focused on early-stage tech. They invest in ShopMy. So that's an affiliate social commerce platform for creators to monetize influence. Agentio, an advertising platform for purpose-built creator content. And they invested in Vault Labs, which is a digital music collectibles platform for new ways for music artists to share and monetize content. Bain Capital Ventures, that's the VC arm of Bain Capital, investing seed all the way to growth. They invested in WAP, which is a social commerce platform that lets online creators and entrepreneurs launch hubs to sell digital products. They invested in Krea, a generative AI platform for visual creatives. They invested in ShopMy again. Hustle Fund, it's a pre-seed and seed stage firm that views individual creators as small businesses often. They invested in a startup called Punch Up Live, which they define as Shopify for comedians. It allows comedy creators to promote shows and sell tickets directly to fans. Fabric, a hybrid co-working space and online platform for in real life communities. Yuzu Labs, a generative AI video and avatar creation tool. Knight Ventures, Knight is a talent management company of creators like Kai Cenat. They also have a fund. They invested in Outtake AI, an AI tool to protect creators, brands, and businesses from deep fakes and identity misuse. Super important. Trovio, a platform that enables creators to license their videos and other content for training data. Bond Capital. Bond Capital is a global venture firm, growth stage focused, led by a woman named Mary Meeker, who runs an elite level research report she's been doing since 1995. They invested in Whatnot. Whatnot's a live shopping platform that lets creators and sellers host real-time auctions and shopping streams. They invested in Substack's newest $100 million round. Substack is a newsletter publishing platform that enables independent writers and creators to monetize through paid subscriptions. Patron. Patron is a seed stage consumer tech fund founded by former Riot Games executives. These guys are investing exclusively and aggressively into gaming communities and things around them. They invested in Ego, an AI gaming and simulation startup. Sweat Pals, a fitness community platform that provides tools for fitness creators to monetize their followings. Chronicle Studios, a content studio that partners with top creators to develop new entertainment franchises, IP, series, and movers based on creator-led concepts. First Market Capital, they invest strongly in consumer technology. They were early in Pinterest and Discord. Pinterest is a visual discovery platform. Discord is a community-based platform that allows people to interact over the open web and also create different roles. Precursor Ventures, they're a pre-seed firm led by a guy named Charles Hudson. They invested in Rella, a digital workspace for influencers and content creators. Clutch, a marketplace that connects digital creators. And finally, Spice Capital. They are run by a woman named Maya Bakai. Their thesis is that everyone's a creator. They invested in Beehive, it's a newsletter competitor to Substack. They invested in Dirt. Dirt is a digital media company that started as a newsletter and expanded into a network of niche content brands. They invested in Hype, which is an app for trading meme coins. Those are viral community-driven cryptocurrencies that are often launched on Twitter, or now known as X. They also invested in Mubi. Mubi is a global streaming service and film distributor known for curating high-quality independent films that are not dependent on traditional streamers, and they run a social network for cinephiles. Those are people who love art noir and different types of film.
A lot of money is coming.
Notified.
Slow Ventures, their like creator fund, I believe, is $60 million. Is that correct?
Correct.
And all of these investments that you mentioned, all of this capital that's been deployed has been arguably in the last 5 years.
Yeah, some of them are early investments, right? Like people were early in some of these companies like a Pinterest, like a Discord, but that's still part of the creator economy. Like what's old is the rails now that people are riding on. Right?
Yeah.
It's like MTA. It's like you don't know how old the tracks are, but they update the A train and they update the inside. So that's the consumer. But the rails are already there. So you're not worried about whether the rails happen. What happens is when there's an issue on the track, your train slows down. So I think it's thinking about this is an ecosystem that feeds itself. So someone on Substack has a paid subscription. Substack taking on capital is because their bet is that they can create an actual third space on the internet, and they need capital to do it, but they need certain creators to choose Substack because that's a signal in the market that it's a good place to be.
What I find is that the beauty of all of this is the fact that creators can actually leverage multiple platforms that we mentioned today,
Mhm.
right? So, like, really, these platforms that we're talking about today just actually have to cater to a particular type of creator and have to create an ecosystem within it to incentivize the creator to use it the most. And when I think about that, I think about like Joe Budden and his usage of Patreon, right?
Mhm.
Like, I wonder how many creators were just like, yo, Joe Budden's on Patreon. So I'm finna just run my joint on Patreon, right? And he's able to run a successful business on there. So I'm gonna follow that. But you don't necessarily have to stick to that particular platform because there are so many other platforms that are going to serve your particular type of business. And then on top of that, like your funnel could be a completely different funnel. And we'll kind of go into what different options you have in terms of infrastructure and building that up in a later episode. But these are some of the things that as a creator you need to really start thinking about, right? Because it's like your artistry is literally just what the consumer sees, but your ability to continue building out your artistry is something that you can actually do if you actually put a I hate to say it and I hate to like mix these two things up, but you got to kind of put your corporate hat on, right? Like creators are almost operating like the new startups. And if that's what they're doing, then you actually have to create and manage your joint like a startup would be managed. And I also find it interesting that this is a market and economy that's like really opening up to investors because now it becomes, do you invest in a traditional startup or do you invest in a creator, right? And the other thing is, like, are startups basically going to be creator driven? One of the things that we're seeing in the market too is that a lot of companies are literally hiring creators as jobs. So, like, what used to be back in the day as a career in marketing or a career in public relations now is just a creator position, right? And a lot of brands are actually going into the space where they're allowing creators to operate these side kind of social media pages for them to be ambassadors for the brand on that platform, but also to test out new concepts, new hooks, new plays, new media types to reach a particular audience. And if they are successful in that, then they actually roll them into the main page, their main feed, right? So creators are playing such a larger role in the overall economy that, back in the day when you used to say, yeah, mom, I want to grow up and be a YouTuber, and your parents used to laugh at you. Today might be the day. You might wanna show them this video and tell them what now, right? I don't know. I feel like it's time for them to say what now, and the reason why I feel that way is because of all the data we presented today. I don't know. What are your thoughts, John?
Yeah, I just want to keep talking about this money. Okay, so back to the private equity firms, real quick. So there's also a larger conversation around these larger agencies and structures that have been in sort of entertainment and media that are actually growing and expanding into the business of creators, right? So private equity firms have been sort of funding these brands with proven revenue or proven talent rosters or even talent management agencies. So I want to talk about a few of those because I think when we see sort of large movements that happen in these spaces, we don't always think about the capital required to do it. And I think that's very important because that capital actually flows into and across the ecosystem and it affects the total value of the market. So,
So I don't know. Can you explain that a little differently for me?
so Private equity is in the business of taking an existing company and creating more growth so that you can actually take that business and have it be acquired for more money
Yeah.
or actually move that business. When we think about creators in the creator economy, it's important to talk about the creator economy is not just a YouTuber. It is the tools and services that that person might use. And then it is the talent agency that might sign that person who was very good at using those tools and grew. So that's still part of the creator economy, which is why a private equity firm like Blackstone would invest in Candle Media, which is Hello Sunshine and Moonbug Entertainment. Those are Reese Witherspoon's company. And so Moonbug also started with YouTube kids franchises like Coco Melon and Blippi.
Mhm.
And so if you think about like what Coco Melon did on the internet, if you had kids and you didn't hear about Coco Melon, I don't know where you were.
I mean, once you put Coco Melon on, bro, like it's like the kids are possessed.
But Blackstone saw that and was like, yeah, for sure. I think you'd like some money. We like that. They also invested in Epidemic Sound for $450 million. Epidemic Sound is a platform that provides royalty-free music for online creators and also allows artists to put their music into that platform and get sync deals and rights. And so if you're Blackstone, you're looking for what is an outsized return on investment that's not correlated with the stock market, music royalties. So that's a good use of my money.
Yeah.
All right. KKR put money in ByteDance. What's ByteDance? The parent company of TikTok. Good money. SoftBank. SoftBank put money in JellySmack. JellySmack helps digital video creators maximize their reach and revenue. Pretty good use of money. Carlyle, Entertainment 360. They took a minority stake in the talent and literary management company known for representing actors, writers, and the creators behind shows like Game of Thrones. This was the first time Entertainment 360 took outside funding in its 20-year history. The management firm's board said, the future of entertainment will, more than ever, be shaped by entrepreneurial talent. Providence Equity Partners took a significant stake in Wasserman to bolster the agency's growth in representing athletes and creators. Wasserman then went out and bought Brillstein Entertainment Partners, a Hollywood management firm. It said, better service its clients as they pursue deals related to content creation. So I guess the reason I want to talk about money and can remove the Munyon bonnet is really that when we have this conversation, everyone is watching what happens. The question is, what vantage point are they watching from? Are they watching as a consumer? Are they watching as an investor? Are they watching as a person who's like, man, the market's actually moving towards this kind of behavior? And so what bet and what thesis am I willing to put money and capital behind for where I see things growing? And that to me is actually the story underneath the, well, they're just a YouTuber, or I don't understand streaming. It's like willful ignorance doesn't make you a good analyst. It just makes you a bozo. So the question is, if these things are all happening and they're public, why are people putting money into it? And our thesis and our belief is it comes down to consumption habits. Linear TV is diving, streaming is splintered, advertising dollars is shifting. And so the eyeballs are on creators, right? And so if the eyeballs are on creators and the creators are actually able to move markets and have people make decisions, I want to be a part of that because there's an economic incentive to be there.
Yeah, I feel that. For me, the way I've viewed everything that you've said is that as a creator, you have to actually think about yourself a little bit more.
Yeah.
Right. So like you're not just on-screen talent anymore. You are the face of a company.
Mm-hmm.
And when you're that, right, you have to actually think differently, move differently. You actually have to think what might be 10, 20, 30 steps ahead of what it is that you're doing. There actually has to be a level of intentionality behind what it is that you're trying to put together.
Yeah.
Right. So like if you're saying, "Hey, I'm gonna make content today." Um, it's not about saying, "Hey, we're gonna make content about dancing." It's, "Hey, like, I think one day I want to open a dance company," or, "Hey, I think I want to actually create a new tap shoe," right? And what you're doing is you're using the content as a vehicle to not only communicate that to a particular audience, but to also gather data behind whether that's actually a viable venture, right? Um, I also think if you're a creator now, at least based on our analysis today, it's actually identifying like open markets,
Yeah.
right? It's sitting down saying, "Hey, like I've actually found a market where there's a need for a particular type of product, or there actually needs to be a particular type of perspective in a particular space." Um, Kind of like Jonathan's example earlier with Jonathan, who said, "Hey, like woodworking is kind of boring right now. Let's actually start making some videos about our interest in woodworking, and then let's see how that goes." Right. So, like, these ideas behind what's available out there and being the creator to communicate that and build that audience out. And once you're able to build that, then it's saying, "Hey, what kind of structural business am I going to build under that?" And it doesn't have to be t-shirts. No disrespect to t-shirt makers, but we don't have to keep making t-shirts in order to build a real business. We've listed out a bunch of examples, platforms that have been invested in, types of businesses that have been built where going to merch does not necessarily have to be your immediate play. It could be something completely different, right? And um because that opportunity exists, you shouldn't miss it by only seeing 1 or 2 steps ahead of you.
I agree. I think so. Some new data came out in July of 2025. Nielsen is a market research company, and they study consumer consumption habits in media all over the world. Every month, they have something called the Gauge Report, which measures TV consumption in the United States across streaming, cable, and other sort of sources that people use. The July data said that 47% of consumption was coming from streaming. All right, so we know that that's going to continue to grow. But when you look at the graph and the breakdown, 13% of that is on YouTube. So that measurement is TV. So they're measuring people opening up YouTube on their TV at home, not mobile, on TV, and watching content, consuming shorts, letting the algo feed them. And so I think that that fragmentation is the norm. And I think that creators are the most efficient distribution source that's ever shown up, period. And the street loves efficiency. And it is way more efficient to move consumer products through a person than it is necessarily through a warehouse, because the supply chain starts with who's communicating where the value is. And what's really exciting about this moment in time and why we're talking about this so aggressively is because this is a new economic reality that touches every facet of our lives. Anything you're interested in, there is a creator and a market being formed. Music, fashion, movies, fitness, politics, anything you touch, there is a economy around that with people who are interested in both consuming, engaging, and partnering. And creators are actually the linchpin between those things. They're setting taste, they're creating new forms of consumption. They're breaking artists. You got people like Black Boy Max. There are things that labels are shifting their attention and spend to engage and break artists through streamers. They're showing up at live events. They're covering the Olympics. This is not some kind of fluke. And I think it's really important to be mindful of who dismisses what and what's the incentive to not pay attention. And so our incentive is to showcase things that we think are relevant for you, things that you can embrace and take with you, and hopefully have uh, definitive impact on the things you want to make and the things you care about building.
Yeah. I think that's the best way to end the episode. Like,
Cool.
like your soliloquy was actually perfect because it's covering everything.
I gotta be serious. 'Cause I had this bonnet on for a long time. If you're gonna
Facts.
cook me, so
Yes,
I
they
got
are.
time for that.
But the bonnet was fire, dog.
Yeah, I know.
I guess my parting words are, there's a lot going on in the space, and I'll just give y'all one example. Zach Bia, made his own label. It's called Field Trips. It's called Field Trip, right? Yeah, Field Trip.
Yeah.
And his entire label is actually run on JVs. So what he does is
What are JVs?
joint ventures. And what he does is he goes to either artists or creators and he says, "Hey, we want to help you continue building a relationship with your audience. We want to be way more efficient than what a traditional label deal would do." And the reason why is because a lot of existing labels don't necessarily have the ability to care for every single artist, and they're also not on the ground, not on social as much to be able to stay on top of what audience tastes are and also do that effectively for every single artist that is signed to them. So Field Trip actually just literally provides that service to artists, and then they enter a joint venture with a traditional label, and that traditional label actually handles all of the infrastructural stuff. So it's your distribution, your publishing, that
Mhm.
is handled. And they've signed Yeet, they've signed Black Boy Max, and several others. Um, Zach Bia himself is not an artist, no rapper, he's none of that. He's just a dude who used to work at Delilah's in LA. And he has built relationships over several years, and now he DJs. So he breaks artists, right? And that's effectively what he does. He is a creator that created a what looks like not necessarily the entire future of labels, but one vision for what the future label could be.
Mhm.
And I say that to say that I don't want anyone to be stuck behind any particular model that they hear us talk about or hear other people talk about or hear other people do. But what your goal should be is to find all the bits and pieces that you believe work for you and then implement them yourself. Test them, try them out, and see if they work for you and if they work for your audience. And if they do, then you get to structure a business that works for you. Those are my parting words. So I guess that's the end of episode 1. Um, welcome back, John.
Good to be here.
We back. We out here. And the statement stays the same. Don't follow me. Don't follow John. Don't follow us. Just follow the money.
The opportunities of technology are huge for content owners, in my opinion. They always have been. And as an example, the way that we market movies is undergoing a radical shift. It used to be that you spent a fortune running advertising on TV to run your trailers. And now, we can reach that same audience much more effectively on the web through whether it's Facebook, through whether it's targeted communication with loyalty groups, whatever it might be. When we went to the music companies, we said, "Who is your customer?" And they said, "Oh, it's Best Buy and Target." And what was the record company?
Tower.
Tower Records, that was it. and Tower Records, they thought their distribution channel was their customer. You know, in the same way that people making movies might think that your movie houses are their customer, but they're not. Their customer is the viewer, just as the music company's customer was the listener. The music companies had no connection with their listeners whatsoever. And so what changed in the music industry was not the back end of the business, the A&R, the seeking out and developing of artists and talent over, you know, which is just as important now as it ever was. What changed was the front end of the business. The distribution and marketing became, was able to be done in a much more effective way, bypassing the distribution channel and going direct to the end user.